Welcome to the 18th lecture in mathematical finance. So today we want to finish the part about American options, and the last thing I would like to discuss in this area is the hedging and pricing of American option in an incomplete market. So in a market where it's not possible to replicate every European contingent claim. So this would be a rather relaxed part, because I just want to give you an outlook and without any proofs, and what you're invited to, well, if you're interested, to sit down and read it on your own. So all the theorems and propositions and so on, which I present in this part, will have no numbers because, well, I'm not providing proofs and I will not use them in the following. All right, so as I said, this is discussion. An American option in incomplete markets. All right. Okay, so of course, what we want is always, we still assume that the market, so the underlying market, is a one-dimensional market as before. So we have a risky asset and one risky asset and one risk-free asset. Finite and arbitrage free, because these are the minimal assumption we need to talk reasonably about hedging pricing of options. And what we want to consider today is an American option. So American option, as usual C, so we know American option can be exercised at any time before maturity. So what we need to ensure that we define it as a process. So this is a non-negative adapted process indexed by our time set. And the maturity time is the terminal time of our model, capital T. Right. And compared to what we have done or seen in the last lecture is we drop the assumption that the market is complete. So this means here the set of equivalent martingale measures is non-empty, right? But there might be more than one. And this is something where you see there might create issues with the proof of the proofs we have developed last time. So if we take the stopping time tau, and what the stopping time should be an exercise strategy of our American option. So we assume that tau is less or equal than t. Well, and then we know that if we consider now the price of the corresponding European option, so the stopped American one, so if I stop the American option with a fixed stopping time tau, well, it's a European option, right? It's a non-negative random variable, and I can identify it as a payoff with maturity capital T, right? So we know if it's a European option, we know there's now a set of arbitrage-free prices described by this interval here, which can be expressed with the expectation of the discounted European option here. And then the expectation is taken over all equivalent martingale measures. Okay, right? This, so that you all probably all have it very good in mind currently, but just to make sure this is the set of equivalent martingale measures. Okay, and now, so this is what we have developed. In European options, we understood entirely how to price and hedge it, super hedge it in an incomplete market. So this is, I mean, what we well understood, and now we basically want to develop very analogous theory in the case of American option in an incomplete market. So you will probably recognize that the results naturally transfer, but the mathematical tools one needs to prove them, well, they are unfortunately outside the scope of the lecture. So because we want to do also other things like portfolio optimization and risk measures and so on. So this is unfortunately not the focus of the lecture, but you will not be surprised to see how the results look like. So what do we want to understand now is the set arbitrage-free prices of the American option. So if I, right, in the same way, so if I look now at the set of arbitrage-free prices of the American option, see. So what can I say about this? So what we know is by the definition, number PA is in this set. So this is my set. I mean, it gets a bit longer if we have American options. So we have two conditions to say that something is an arbitrage-free price of an American option. Is the set of. So what is the first condition? Well, the first condition is there exists a stopping time tau in, right? So stopping time, we assume that it's an exercise strategy, so this tau has to be less or equal than t. And there exists a price in the set of the arbitrage-free prices corresponding to the corresponding European option. So C stopped at tau, such that the price of the American option is less or equal than this corresponding price of the European one, right? So this means the price is not too expensive for the seller, for the buyer, sorry. So the buyer is willing to pay this price PA in order to get the American option, because he can find a stopping strategy, exercise strategy, which tells him, oh, the price is worth the pay. Right. So what does this imply? Well, this implies that what when I look at the price here, right, this is the last equality here. So PA is less than P, and now I know from the theory of the European, the pricing of European option, that this pi can be expressed as the expected value under some equivalent martingale measure Q of the discounted European option. So the option C tau for some Q. Right. So this is the formula we have seen here. Okay. And now let us recall the second definition. Right. The second part of the definition tells me, well, there exists no stopping time. Tau, yes, which has to be an exercise strategy. So let me call it tau prime, because it should be distinguishable between these two taus, which is stopping time, such that, so the price of the American option is not too cheap. So there's no way that the buyer of the option can really make some profit. So surely so make some arbitrage of this price. So meaning he can stop it in a way so that for all pi, right? So that if I consider the stopped, so the European option I generate by stopping with tau prime, this option has always a strictly higher price than, so among all the martingale measures, than the American one. Okay. So what does this imply? Sorry. This means that if I look at the price of the American option, this should be always bigger than the minimal price, which is still arbitrage free of the European counterpart. Okay. For all. And this holds for all stopping times. P. And tau has to be an exercise strategy, so it has to be less than or equal to T. Right? Okay. Right, so what we see here is we have an upper bound and a lower bound. So let me use these two statements and combine them. Well, so let us take now the supremum of all stopping times. So if I take here the supremum of all stopping times, what do I get? And well, all stopping time means all exercise strategies, so less than T. You have the infimum, so this is my lower bound, Q and M. And well, right. Has to be less or equal than the every price, arbitrage free price of the American option fund, right? This is condition 2. And now we use condition 1 as well. Right, so what is condition 1? This gives me an upper bound, right? So I can here also take the supremum of all stopping times, which are less or equal than T. And what do I get here? Well, I can make this bigger by taking even the supremum of all martingale measures, right? Because if there's some which is bigger, if there's always some which is bigger than PA, then well, if I take the supremum, this makes it only bigger. To what do I get here? I get the upper bound given by the supremum of all exercise strategies, and then the supremum of all martingale measures, and of the discounted European counterparts. So these are the prices of the discounted, the price of the European counterparts generated by stopping with respect to tau. Okay. So what you see is if we take any arbitrage-free price of the American option, for the American option C, it has to lie between these two expressions. Right. And actually, this can be turned into a proper proposition. And as I said, no numbers because, well, I will not use them and not prove them. So what is this? Is the statement here? If I have an American option, so I have either that my set of arbitrage-free prices exists of exactly one element, right? This is the case we have seen if we have a complete market. So if a complete market, I know there's exactly one arbitrage-free price of the American option C. So this might happen because, well, we are not excluding complete markets if we consider incomplete markets. Or this right, the set is an interval, right? Exactly as in the case of European options, right? It's really an incomplete case, so there's more than one price for the American option. This means it's an interval, so the prices span an interval, and you won't be surprised that the bounds I have derived are exactly the minimal arbitrage-free price. So if I consider the infimum of this set of all arbitrage-free prices for the American option, the infimum is given by this first part here. So so by the supremum of all exercise strategies, and then the infimum over all equivalent martingale measures, and then I take basically the prices of the European option generated by the stopping times tau, and the supremum of this set. This is of course a statement, not a definition. Is given by the upper bound I derived here. So take all exercise strategies and the supremum of all. Right. So what you see, I mean, the little heuristic bounds I have derived, I mean, they're properly derived. So, so you know, all the American options have to be inside these bounds, but actually it turns out that this is really, these bounds are sharp, right? So the set is really spanned of the interval between these two values. And this is, if you recall, for European option, exactly the case, right? Either the option for European option, either the option is replicable, and this is if and only if the price is given by a single element, or it's non-replicable, then it's a proper interval spanned by the supremum and the infimum, just without, so the supremum of all martingale measures and the supremum, the infimum of all martingale measures. So you just have lost. I mean, you just have not the supremum there. So if you think of the European one, this where you bounce, right? So you just cross away the extra rights from exercising. Okay, this is okay. Okay. Now let us understand a bit better this case of a single element. Because this we understood for the European option. Okay, I have a unique price if and only if the option is replicable. But what this replicable means for American option. So let me give you a definition. What I mean now that the American option is replicable. So here is called, let me call it attainable, because I mean it's in the end in the proper sense of the word, it's not replicable, right? Because you're not exactly generating the payoff, as you will see in a minute, of the American option. You can find a stopping time tau, which is an exercise strategy. So tau is less or equal than t. And hedging strategy, right? This is the hedging strategy in the sense of the European sense, that you can hedge the corresponding European payoff, right? So what does it tell us? I mean, this is a hedging strategy for the American option, meaning if you're always generating a higher payoff, so a higher value. Let me add this here for the American option. Right. So if you trade in the market with respect to the self-financing trading strategy, fine. It always gives you higher value at each time step than the possible payoff of the American option. But now it's called attainable if you can also find a stopping time where these two match, right? And this is will be usually the optimal one. Okay, so this is what I want to call attainable in the context of American option. Okay, and now let me give you a last proposition, which will probably look very familiar for you if you go back and recall what we have learned about European options. So what is here our proposition? Well, the proposition is telling, well, my American option C is attainable if and only if the price of the American option, so the set of prices of arbitrage-free price of the American option is a single element, so that's a unique price. And furthermore, what can we say? So if in this case, right, so if it's attainable, then the price P, so the arbitrage-free price of the American option C is the initial capital required for any hedging strategy. Why? Such that tau, so if I stop my trading and with respect to a certain stopping time tau, I exactly get the payoff of the American option for some, right? This does not need to hold for all tau, but for the optimal one, basically. And of course, I mean, we're only considering stopping times which are less than t, right? So for any, in particular, also means that you cannot do better, right? So the minimal initial capital, if you want to find a hedging strategy which matches the payoff of the American option, if you stop optimally, has to be the arbitrage-free price of the American option. Right. Okay. And this is, I mean, just please, I mean, take a minute, go back to the notes of the pricing of European option. You recall, well, in America, a European option is also replicable if and only if the price of the European option is unique, so it's a single element. And in this case, well, you know, the minimal initial capital you need to replicate the European option is given by the price, the arbitrage-free price. Right. Okay, I was here. Let me the box. If you want to look for more details on the proof of these theorems I just gave you, please have a look at the book of proofs in the book of Velma and Sheet. This is section chapter 363 to 65. Of course, I mean this is up to you, so I'm not expecting you that you look into this book, but if you say, oh, this is interesting, maybe I want to have a look how this is properly proven. And of course, it's harder than what we have done for the European case. Okay, just a side remark. Okay, that's good enough for me for the pricing and hedging of American option. So just to recap, like on a meter level, what we have seen so far. So we started to understand, okay, what is the basic principles we want to develop, for what we want to assume to develop mathematical finance. We did the necessary background interesting processes in discrete time. And then first thing we need to do is we need to study, if you start modeling a financial market in discrete time, you need to ensure that it's arbitrage free, right? Because otherwise it does not fulfill, so the model does not satisfies our basic agreements how a financial market should look like. And then in an arbitrage-free market, we started the pricing of financial options. First, the case of European ones, right, where you have a fixed payoff, I mean a random payoff, but at a fixed maturity time t. And then we went to the pricing of American option, where you have additional exercise rights, because which creates an asymmetry between the buyer and the seller of the option, and this needs to be reflected in the pricing and hedging problems. So we discussed this. And now we want to open a new topic which tells me, okay, if I'm now an investor on a financial market, I would like to understand, or try to understand how how I want to invest in such a financial market where assets are traded. This brings us to our the next chapter, which is chapter 6, which is portfolio optimization. So we are not talking about, okay, what we want to sell option and price them. No, we want to understand now. If we have a financial market, we're an investor, we have some initial capital, and we want to invest it in a market which is optimal in a certain sense. So we want to basically maximize or optimize our our investing in the market in a way that it maximizes some target function. And the target function is, of course, our decision. What is our goal when investing in the financial market? And to understand, okay, what are reasonable goals or reasonable target function we want to maximize, let us start with a little example again, as we also started basically all the chapters so far, to understand what is realistic. So what are the assumptions we want to make? So let us consider again. I mean, we start with the simplest model we know, because it has shown to be rather fruitful when understanding the hedging pricing problem. So let us again look at the binomial model. With one trading period, right? So we have our risk-free asset, we have one trading period. So we have time 0 and time 1. So what, as usual, because I want to do some calculations here. So let me recall for you what exactly the processes are, right? So you have the idea of a bank account. So the risk-free asset is given by here the interest rate, let's say non-negative, right? So you have a deterministic process described by the idea, okay, if I put some money in there, it grows with the interest rate R, and then I have 1 plus R at time 1. And we have the risky asset. Also one step. Yeah. So what is it? So we start at time 0 with the non-negative constant. So this is the initial price, should be. And so what is the price at time 1, right? So there's time 1 is the future, so it's a random object defined as usual by either you go up with the factor u or you go down with the factor d. And this, of course, depends on the random outcome on our sample space. So our sample space consists of 2 elements, u and d. And well, as usual, we assume that d is a non-negative number, which is less than 1 plus r, and this is less than u. Right, these are our condition. We need to assume that this, in order to ensure that the market is arbitrage free. And okay, another thing we need to assume is that both cases, so U and D, can appear on the market. So the probability that U appears has to be strictly between 0 and 1. Because otherwise, I mean, if the market is not arbitrage free again. Okay, this is our setting. And if I have such a market and want to invest in it, well, I want, of course, to invest in a self-financing way. So I want to keep the idea that I'm not throwing away or withdrawing money. So the vectors in R2 are my self-financing trading strategies. Okay. Right, because I mean, I can only invest at time 0, and at time 1 my market is gone. So I don't need to talk about predictable processes. Very simple. This is my predictable process as one element, I mean, one time step. So that's my investment at time 0. Okay, what is now the problem I would like to consider in this market? Or you might have seen similar examples also in some economy courses. So what do I want? I want to maximize my, so I have given initial capital, right? I'm an investor. So given initial capital, x0, right? It's a hopefully positive constant. So I have my initial capital x0. There's the money I can invest at time 0, and what I want is to deal with the optimization problem given what do we want to maximize our expected terminal wealth, right? So we invest at time 0, and well, we start with the naive idea that this is our goal, that we can choose a self-financing trading strategy. And at the first try, we think, okay, well, if I'm an investor, it makes sense that I want to invest and maximize my expected wealth at the terminal time. So here, one step in the future at time 1. And of course, I can only split up my capital. So at time 0, I know I have these x0 of capital, which I want to invest in the market in a self-financing way, which hopefully maximizes my expected future wealth. Okay, so this is our problem. We at least want to start with the solving. And then the first guess, it looks rather reasonable. So let's solve it. Right. Okay. First, well, okay. We have, of course, hope. I mean, this is a very simple model, so it should be not too hard to solve it. So what we know is, this is the first constraint here, that it doesn't matter which trading strategy I pick, my value at time, so the capital I have of my trading strategy at time 0 is given So x0 or is given by the number of shares I hold in the risky asset plus the number of bonds I hold, and this is normalized to 1, right? So b at time 0 is 1. So to 1. And the second thing I know is, well, then the prices involved. So the capital I have at time 1, and then alpha times the price at time 1 plus beta, the price at how the interest rate growth. All right. So what does it tell me? I have two equations. So let's plug in the first one into the second one. I pull this out. So this is, right, this is here the second equation. If I do this, I get here to divide by b1, then I have beta minus beta. And now I can rearrange the first equation to have beta. So I can plug in now this here. So what do I get? I have 1 beta for b at time 1. I have my initial capital plus alpha, the discounted price process minus S1, right? Okay, and I can multiply it out. So this here, the initial value at time 0 is just x0. Then I have plus alpha, so right here the beta 1 is canceling. Then I have minus S0 multiplied with b1. Yes, and I lost an alpha. So here we are. Okay. Okay. And now, okay, I want to optimize here. And, I want to actually the expected terminal wealth. So let's take the expectation here. Okay, so we want to actually maximize the expected wealth at the terminal time 1. Okay, this is good because I mean here, if I look at the right-hand side of the equation above, here there's only the random variable S1 involved. Well, this can take 2 values, so I can calculate this explicitly. So x1 is deterministic, b1 is deterministic, x0 is deterministic, so there's nothing to do. I get alpha is 0, and now my S1 can be S0 multiplied with u with the probability p, and the same. Then I go downwards, so d multiplied with 1 minus p. That's good. And then here, okay, I put the S0 and the alpha in front, and b1 is nothing else than 1 plus r. This is just the definition of b1. Okay. So what does it tell me? Well, what do I observe here? I look at this. So what I observe is actually, I can always ensure that this expected value goes to infinity, and in the case that u, so basically that this factor here is positive, right? So if I assume that plus 1 minus p is bigger than 1 plus r, I can choose my alpha arbitrarily big and let it go to infinity, so my expected value goes to infinity. And the same, of course, can be ensured by the reverse assumption here. So if this here in the case is less than 1 plus r, well, I send alpha to minus infinity. Right? So what this means is, in the first case, well, I put arbitrarily large amounts of money in the risky asset, so I invested in the risky asset and I borrowed in the interest rate. But since in average the risky asset is in favor for me, I make huge gains in average, right? So because I have a downside risk, which means I could lose a lot of money as well, but fuck it. So what you see, if I look at these naive, I just maximize the expected terminal wealth. I could become, I mean, this is somewhat degenerated in this mathematical sense, and it's saying, okay, it's always infinity. And what you probably will agree, this is behavior is unrealistic. So even if you're an investor and you believe that this is the right thing, you would not put all your money into the risky asset. Yeah. Unrealistic. Why? I mean, why is this usually this unrealistic is usually explained or often explained by by the risk aversion of human behavior, right? So most humans prefer to have a certain payoff with a low risk rather than taking, so betting on. So most people prefer to have a certain payoff of, let's say, 10 euros at the end of the month than with a small probability a payoff of 1,000, and with a low probability you lose 100. Right? So even if you're an average win, most people would tend to say, okay, let me take the certain payoff and I'm happy. But there are a lot of studies on it. But what, I mean, one of the main reasons, at least, is what people tend to be risk averse. I mean, here in this, in this simple mathematical model, you might even say, okay, even if I believe the world looks like this, there might be some type of model risk that, so you maybe have the wrong model. So you're not fully trusting your model, which is, of course, good idea, as it's just an approximation of the real world. All right. So this is not the right idea. Let me give one final remark. I mean, why this, where this investment behavior in the simple model comes from. So this is, okay. Where it comes from is, well, because we understand now the mathematics behind it. So I think this is, we should observe it at this point. But if I look at the first condition here, where I want to put all my money into the risky asset, right? So this is my condition I face here. So this is here the first one. So what does it tell us? Because we are here a mathematician. So let me do some simple algebraic reformulations. Okay. Yeah, that's not surprising. Then I see that P is strictly bigger than 1 plus R minus D divided by QD. And now, what is this? Q. This is equal to Q, and Q, as you recall, it is the martingale measure, or determines the martingale measure in the binomial model. So Q is the probability under this measure Q that it goes upwards. Equivalent martingale measure. Okay, so what you see here, the probability under the physical measure P that the price, the risky asset goes upwards is higher than under the risk neutral or martingale measure Q. So okay, and this is what does it tell us? Well, we also know the discounted price process it's just one step here, so let's keep it simple. It's a martingale and a Q, right? And this means that it is now, if we look at this, under the physical measure P, right? So under the measure Q, this is a fair game. So in average, I lose and gain equally. But now, if I look here at this property here, and I calculate now here the expectation, well, I see that it's a P martingale, a P sub-martingale, right? Because the probability under this measure P that this goes up is higher than Q. Right? So I move the mass from the center to the upwards tend. So this is a sub-martingale. And what does it mean? This means this here price process of this is T is in favor for the investor, right? Because, well, sub-martingale is a game where we expect to win in average. So you see here in mathematics speaking, okay, if we have this condition, which I formulated here in these portfolio maximization problem, I see as well, if this condition here, the first one is fulfilled, so the green mark one, the price process is actually saying there's a risky price process is sub-martingale, so it's a game in favor of us, and as a rational investor, I put all my money into the game which is in favor of us, for me. So you see, I mean, this little calculation has the deeper meaning why the underlying model, right? Because it relates to the idea of martingales describing the underlying market. Okay, but the main message here is actually, okay, if I want to consider this naive green maximization problem that I just maximize the terminal wealth of my investment, that's degenerated. This actually is also unrealistic. So this is not the right formulation of the problem. And to capture the more rational or natural human behavior, one starts to investigate preferences and utility functions. So this brings us to next subsection, which are preferences and utility functions. Right. So instead of saying everyone wants to just maximize the terminal, well, we want to understand what models the behavior of a human investor. So let's start. Start with a finite probability space, so a finite market. Finite market, right? Like the simple binomial model we just have seen. Here the main point is that the underlying probability space is given by m elements. So this is a finite set, makes it easier to work with. What we see here is, well, if we have a finite number of elements, all types of payoff we can generate by investing or trading in a market is given by a random variable, right? So all possible gains or losses we can make described by a random variable. So we care here about the random variable. So we consider a random variable, let's call it x. So this abstractly represents all the investment outcomes we can generate. And now this is the nice thing about the finite setting. That we can, and well, we have already done it several times, we can identify a random variable with a vector in, let's call it x bar in Rm, right? So x is just defined as I evaluated my random variable at these m possible scenarios on my sample space. M. Right. Okay, so this is what we have sort of done to prove the first fundamental theorem on asset pricing, and actually the second one. And what I also can do we can identify the random variable with the second vector, which let's call it p bar. And this is the vector containing, it's also a vector in Rm, containing the probability that these payoffs appear. So I haven't done this for the fundamental theorems, because there we wanted to anyway assign these payoffs a new martingale as a new probability Q. But here we talk about the physical measures, so let me make this identification. And so the idea here is this contains my payoffs, and this contains the probability. payoff, right? And the first one is, okay, this are my payoff, these are the probabilities. And now in the contents of preferences, these payoffs are just called lotteries, right? Because they're random payoffs. This setting, I mean, are lotteries. So this is just to use the language of the area. So abstractly speaking, so let me consider such a pair. Is called lottery if x no. Right, x is a vector in Rm for some, and I don't want to fix here the dimension, so for some m, and right, p is also a vector in Rm, and it should be describing the idea of probability. So should describe the idea of probabilities. If I say this, I should also do it. So the numbers are between 1 and 0, and they should sum up to be 1. Right. So this is these are, I mean, this is the idea I just discussed. So if I have a random payoff in the content of preference, they're called lotteries. Well, this is what a lottery is. You bet on the future. And then the payoffs, what can be described here by m elements, and they appear with different probabilities. And then the set of all these lotteries is denoted. Oh, that's denoted by L. Right. Okay. So this is what I have, and now I want to understand how these look like. Wait, let me make it green. So let me give you an example. Right from the, so if we look at our binomial model with one period, so the one we just discussed, right? So I said omega consists of two elements, so it's a finite space, and the probability that I go upwards is p, and p is assumed to be between 1 and 0. So what does it mean here? Lotteries are, where all our possibilities are exactly the value process. So all the random variables can be generated here by trading the market, right? Because they have a complete market. So all the lotteries are given by the form that I have it as an initial at the terminal value of some trading strategy. And all my self-financing trading strategies are given by these 5, right? So my lotteries in the end, so L lottery. So what is it here if I write it as lottery? So I have my Y, U, phi that D appears, and then I have it with the probability P and minus P. Right? And actually, in this simple setting, all the lotteries look like this. Anyway, all right. So what I want to do is now I want to understand, I mean, what payoffs or here lotteries I prefer. So the goal is we are looking for a preference. So this was denoted by this weird looking greater or equal signs on the set of lotteries. So on set L. So what does this mean? So if we have two lotteries, we write L is preferred to L1. L1 is preferred over L2 if we prefer over L2, right? So what does it mean? Keeping in mind this little example I just gave you, well, this means if I have two investment strategies and I can say, okay, I certainly prefer the first investment strategy compared to the second one, then I write this, that this is preferred over. Well, and we write that they're basically indifferent. We are indifferent between these two if I cannot decide. So I prefer L1 over L2 and L2 over L1. Okay, this is just to fix some notation. We write X for L in L if the lottery, so if I have a certain payoff, so if the payoff X appears with the probability 1, so this is a lottery X and 1, then we just write X because then it's just a real number. Okay, this is, and now we want to agree how such a preference relation should look like. Yeah. Then agree on the following 6 axioms on our preference relation, right? Of course, I mean, as at the beginning of the introduction of this course, where we talked about, okay, what are the basic principles we believe a real financial market should look like, or it looks like, we agreed on certain things. So these were modeling assumptions which you can disagree. And you can also disagree with the list of 6 conditions on my preference relation I will give you now. I'm fine with this, but what you should keep in mind that in the future, if I do my math and starting from next week on again, you should have in mind that these are the assumption I took, and they are hidden in the mathematics I will do. And the mathematics might change if you drop them. So the first one is called comparability. Right. First one. So what does it tells me? Yeah, so many colors. So if I have certain lotteries, so X, so there are lotteries with a certain payoff. So this is actually the last case here. So with probability 1, I get X1, and with probability 1, I get Y. So these are two lotteries. What do we have? Well, for these certain probability, you can order these lotteries. So if I have a certain payoff, I can decide which one I prefer. So if I have a lottery which pays always 5 and another lottery which always pays 7, the investor is supposed to know which one she or he prefers. Okay. So this is, of course, an assumption, but I think it's a fair one to say, okay, if I tell you you get certainly 100 euros or you get certainly 200 euros, I can assume that you can decide which amount of money you prefer. Next one is monotonicity. Okay. All right. So what does this tell me? So let me consider two lotteries. Okay. So the first lottery is given by the vector x1, x2 with probability p and minus p. The second one is given by also the payoff x1, x2. But now the probability q and 1 minus q. Okay, so these are two lotteries. And what I know now, if x1 is bigger than x2 and p1 is bigger than q, then I prefer x1 over x, right? So if I get with a higher probability, the higher payoff, I prefer it. Huh? Even, I mean, if there's of course also the case of lower one, but so I have these monotonicity principles that if I know I have two lotteries which give me exactly the same payoff with different probabilities, and the one gives me with a higher payoff and with the higher probability, the higher payoff compared to the other one, I prefer the one with the higher payoff with the higher probability. Okay. The next one from sensitivity. Right. So what's here the case? Well, so if I have lottery L1, which I prefer over L2, and I have a lottery L2, which I prefer over L3, right? Then I know the lottery L1, so I also prefer, or I can conclude that I prefer, or the investor prefers the lottery L1 over L3. Of course, I mean, seems to be obvious, I mean, or reasonable, but it's an assumption we have to, I mean, make, right? Because could be in theory or principle, so otherwise. All right. Okay, now it gets mathematically. So these three are the simple one, which probably all will say, yeah, that's fine. And now I think it gets a bit more mathematically. Right. So what I want to say is I want to have a certain continuity between preferences. So let's consider 3 lotteries with a certain payoff. Oh, this should be also, oh, sorry, this should be this L. Right. So you have this payoff x1, x2, x3, which all appears with probability 1. And what I want to assume that you have here clear preferences. So you have the 3 is the best one for you. Right. Then you 2 and then 1. Then you want to say, well, they exist. Probability u of x2, so which is here, means in the sense of probability, so it's between 0 and 1, such that if you consider the lottery L given by x1 and x3, so these are the payoffs, and you consider this is with the associated probabilities that x1 appears with the probability u of x2, and x3 appears with the probability u of x3. Right? 1 minus, correct, this has to be probability, so we have 1 minus u of x2. And this new lottery L is indifferent to x2. Right? So you can take the both extreme payoffs, so x1 and x3, and if you assign these the right probabilities, then you're indifferent to the middle one. Yeah, but this is of course a continuity which tells you, I mean, this is really assumption which makes sense, but it's not clear why such a continuity property, I mean, should exist. All right. The next one is compatibility, that you want to be able to compare in a reasonable way lotteries. What does this mean? So you have 2 lotteries, L1, given by the payoff x1, x2, x3, and these appear with the probability 1, 2, 3, right? And you have a second lottery which tells you, well, you have here only the payoff 1 and 3, with associated probabilities q1 and q2. Right. So if x2 is now indifferent, or you're indifferent to, the L2 is indifferent to x3, so right, so the lottery where it has missing the middle payoff x3, but in average you're indifferent to this one, then this implies L1 is also indifferent to L3, where L3 is the lottery, you know, right? Right, where this is Okay, let me. Lottery with payoff x1, x2, L2, x3 with probability P1, P2, P3. So what this tells you is, well, here you have a new lottery which gives you the payoff x1 with the probability f1, p1 with the probability p3. It gives you the payoff x3, and with the probability p2, it gives you the new lottery L2, and this lottery, of course, gives you then with the same probability, with the probability q1 and q2, the payoff x1, x2, right? So this is, again, of course, this is a combination of lotteries, which is in the end, okay, so again, if you describe it as a vector, you can again describe it as a vector in x3, in xm, or here x3 is the x3, and with the probabilities. Here was a bit vague, so that I basically can do what I just have verbally described to you in a rigorous way. I need to have the last assumption on my preferences, which is the decomposability of lotteries, right? So the idea, right, if I have a lottery, which again gives me a lottery, that this is, strictly speaking, again, a lottery, I mean, I have to ensure this. So suppose we have a lottery. Payoffs, which are again lotteries, L1, L2, with probability P1 and 1 minus P. Well, and these lotteries L2, L1 is, well, pays X, well, X1 and X2 with the probability P and 1 minus P. And well, X2 is the same. So you have the same payoffs, but probabilities 2 and 1 minus P2. What's the statement here now? Well, then L is okay, this lottery is indifferent to the lottery L tilde, where L tilde is exactly lottery as we have defined it. So it's X2. It's a payoff, gives you the lottery X tilde, gives you a pay X1 and X2. Now with the probability in the way you would expect it, namely, you have to combine the probabilities of each of the lotteries to get the new ones. No, I missed 2. Right. And I hope I didn't. Yeah. Okay. So this is the what I basically have used. So I was not super strict with the definition, is saying, okay, if I have a lottery which pays again a lottery, then I can decompose it into a lottery is of the form as we wanted to have it. Namely, we have a vector in our M and we have a associated vector of probabilities in our M. I should make this to a vector. Here's right. So with this assumption we made on the idea of lotteries, the lottery is exactly as defined as we have done. All right. What's now? I mean, why do I care about this assumption? Because if I agreed on this idea, on this preference relation which an investor has, I can find a nice mathematical way to represent this idea of this type of preferences. And this brings us to, will lead us, I think, next time to the notion of utility functions. So let me give you already the theorem, but I will probably not able to prove it. So suppose, what's going on now? Why is this? Oh, sorry, I don't know. Suppose we have an investor, and the investor has preferences. And this is the whole point, we want to assume that this investor preferences fulfill our axioms 1 to 6. Further, we assume that there are 2 lotteries. Exist 2 lotteries. Let's call it L1 and L2. With payoff. Right, they pay the same, so they both pay x1 to xn, okay. And this happens with probability p1 up to pn and q1 up to qn. Right. Right. So these are 2 lotteries. They have the same payoff, but these payoffs appear with different probabilities. What is now the claim here? Well, then there exists an increasing function u such that I can represent my preferences between these 2 lotteries, L1 and L2, exactly in the form of this numerical representation that I take my function u, I plug in the payoff, and I multiply it with the probability p1. And this should be greater or equal the corresponding notion with respect to the second payoff. Now q. I mean, we will prove this next time, this theorem, and what we here also want to already keep in mind is like, so if I have these preference relations fulfilling my assumption 1 to 6, I can represent which lottery I prefer by calculating here this type of expectation, right? So this is an expectation. So this is, I take my random variable, which takes the values x1 to xn with a probability p1. So I take the expected value of the function u of my random variable, which are the payoffs of the lottery x, and then I multiply it with the with the probabilities. So this is the expected value of my lottery under the function u, so under the measure p. And well, this will bring us next lecture to the notion of utility function, which is exactly such an increasing function, which allows us to capture the preferences of an investor. All right, thank you.